Investment advisory services offered through SWAN-Capital Management, LLC, a SEC-registered investment advisor. SWAN-Capital Management, LLC, and SWAN-Capital are independent entities.
What your money would say. Andrew McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair, and for the next 30 minutes every Saturday from 12:30 to 1 o'clock here on WCOA 1370, I will be your retirement resource. Now, remember, this show is live and the phone lines are open. Give us a call at 478-3116. That's 478-3116. And we'll be happy to answer your question on today's topic or any retirement or estate planning questions you have today. Now, on What Your Money Would Say, our goal is to take financial chickens and make them financial swans, because we believe as a retiree, you deserve to sleep well at night. You've worked your entire life to get to this point. You've put 3 kids through college. You saved in your 401k plan and even tithed to your church and gave to your local charity. And it's time for you to enjoy the fruits of your labor. However, I see too many families fumble right before the retirement red zone. And that's what I want to keep you listening from. And we're going to take a topic that's really controversial, that most of the times is misrepresented, misunderstood, and a lot of times it's just not a perfect fit for a client. We're going to talk about annuities. We're going to talk about the good, the bad, and the ugly of annuities. And we're going to bring on our subject expert in just a few minutes. But before I do that, I want to share with you an upcoming event we have here at SWAN-Capital. And it goes down to one basic question. When should you take Social Security? Do you wait to take it at 70 or do you take it early at 62? That's a huge question for many retirees out there, because what Joe at the water cooler did is not necessarily the right decision for you. Is Social Security even going to be there for you? At our Social Securities class 101 at UWF in October, the tuition is about $35. You don't want to miss that class, because we're going to unpack those questions and help you answer that for yourself. And if you want to find out more information about our upcoming college class, it's going to be located at swan-capital.com. That's swan-capital.com under the upcoming events tab. And you can RSVP there. And while you're there, be sure to like us on Facebook, follow us on Twitter, and sign up for our weekly market updates so you can stay up to date on the market. Now, if you're just tuning in on What Your Money Would Say, we're going to talk about the good, the bad, and the ugly of annuities. And I've been looking forward to bringing on John Hogan from Financial Independence Group. John is an expert when it comes to annuities. His role at Financial Independence Group is to educate financial advisors on annuities. So this man knows his stuff. So we're going to unpack what the good, the bad, and the ugly of annuities are. But let's start with the basics. If you've heard of annuity, but you don't even know what it is, that's why I have John here. So, John, what is an annuity?
Oh, good question, Andrew. Way to get started, and thanks for having me on. I appreciate it. Let's just keep it simple. An annuity, all it is, it's issued by an insurance company, and it's just a contract between the client, the person who's buying the annuity, and the insurance company. And at some point in time, the client's going to look for some sort of income stream, either for life or a certain period of time, depending on the payout option that they may choose. And just to keep it simple, again, there's 2 types that are most commonly known. There's a deferred annuity and also an immediate annuity. Deferred annuity, just to keep it simple, you're going to leave your money. It's going to sit for a period of time. There's some that you can make contributions to, and then you're going to take income from it maybe 5, 10, 15 years down the road.
So there's a lot of options with annuities, but they're held and done by insurance companies, which can be kind of confusing, because I see a lot of times clients of mine will come in and say, Andrew, I had this account at the bank, yet it's not at the bank. It's, it might have been done through a major bank, but it's actually held at an insurance company, which can kind of be confusing and sometimes misrepresented. Do you ever see that?
I do all the time. If you take a look where, like CDs, for an example, held at the bank, and a lot of people out there have CDs, and they're FDIC products. And the I if people don't know this, it's insurance within that acronym. So, I would say the insurance company, if you're taking a look at different types of investments, when you're looking at an insurance company, take a look at their AM Best ratings. Take a look at their Standard & Poor's ratings. They're rated on a quarterly, sometimes biannually basis, depending on the strength and the company in the background.
Yep. And we got to make sure if you ever look at buying an annuity and you're unsure, if someone's trying to recommend an annuity, at SWAN-Capital, we'll be happy to give you a second opinion to make sure if that is a good fit or not a good fit for you. Mm-hmm. But so we know that annuity is a contract with an insurance company. Mm-hmm. So is life insurance. That's a contract. Now, life insurance protects you from if you die too soon. However, annuities is the opposite bet. It's protecting you if you live too long.
That's exactly right. And that's probably one of the main reasons that if someone were to ask, why should I put my money with an insurance company? When you think about it, there's only a couple other things that's out there that's offered that guarantee an income for life, and we can name them. There's Social Security, there's a pension, and
those may or may not be protected.
Those may or may not,
especially if you work for a big airline company.
Yeah, and you take a look at us. I mean, that may or may not be there for us whenever we're at that point.
Right.
So, I mean, and then the other is what you specialize in with veteran benefits. That's something else that's guaranteed for life. But besides those three, unless you know of something else, I can't think of anything that guarantees an income for life, and that would be an annuity contract.
Which is so important for today's age because people are living so much longer. Sure. The life expectancy at 1900 was only 40 years old. And, I talk about in my Social Security's class that even when Social Security was enacted, the average age life expectancy was 62. Now we're at 75 and 82, respectively, for women and men, for men and women. And so we have to plan accordingly. We have to look at investments that may protect our investments from outliving our investments, which is, again, so many retirees fear out there, yet they don't know where to turn because when they hear about annuities, they also hear about the when it's misrepresented, it's misused. And sometimes annuities get a bad rap. Sometimes it's worth it. It's actually, the rap is genuine that it gets, and sometimes it's not. So what are some of the bad things about annuities?
Most people feel that because it's in an annuity, it's in a contract, and they feel that
that's a scary word, contract.
I mean, it's there's several different types. There's 3-year, there's 5-year contracts, there's 10-year contracts, there's longer, and a lot of people feel like they never have access to it, which is obviously not true. Most of the contracts that we offer that our advisors use, just like yourself, allow 10% penalty-free withdrawal. After the first year, some allow 10% within the first year, just depending on which company you're looking at. So I think that's one thing that people misunderstand about annuities. They think they can't access
is the liquidity option.
The liquidity.
But if you compare that to a CD, when's the last time the bank said you could take 10% out of your CD?
Well, that's a good point. These products usually they actually they offer more liquidity than a CD.
Right. Continue. So we have surrender charges. That's a huge one. Again, I see a lot of times families had no idea that they got into a product that's a 10-year product, and it starts off with a 10% surrender fee. And so when the family needs it for emergencies, they get stuck with the 10% haircut, and they have to take only 90% of what they put in. And that's a tragedy for a lot of families. Now, let me look on the other hand, though. Many families say, well, I don't want to buy an annuity because of the surrender charges. And here's what I want to, kind of look back from a third party. It says, what about mutual funds? So, if we're not looking at something that doesn't have surrender fees, but if you're in a mutual fund and it's down 20%, that's a 20% surrender fee.
Yeah, and I kind of want to back up to something that you mentioned when you're talking about surrender penalties. I kind of look at it as a good thing. And the reason I say that is because you can tell your clients at any point in that contract, if they were to surrender the contract, exactly how much money they would lose. You take a look at where people have their money and other type of investments. If they want to access that money 5-6 years later on down the road, that advisor can't tell them what's going to be in the account and how much they could potentially lose.
Oh, there's absolutely no guarantee. In your 401k, think about 2008. Who would have guessed that your account's down 30%? Now, some of them, did rebound, but if you were in 2008 wanting to retire, it's a 30% surrender fee. Yeah.
So, I mean, and obviously, you're not going to see a 30% surrender fee on an annuity. So I think one of the other, bad reps that annuities get are fees. You know, a lot of people think that they're just loaded with fees, and that's obviously not true. There's types of annuities out there that you can purchase that have no fees whatsoever. So I just think that's something that people misunderstand a little bit.
And what I know, a lot of families say, well, you know, how do you make your money? I think the truth is good enough. You know, how insurance companies make their money is they may be on hook for some guarantees, but they have, once they have the initial premium, they have the access to go make a percentage on the money, just like a bank. You know, when you make an investment out of a bank, they take the money and they just don't keep it there waiting for you. They go and loan it out to someone else and make a spread off it. Well, that's exactly what an insurance company does, is they try to make spreads, and those little tiny spreads are they're able to pay not only insurance salesmen, financial advisors, they're able to pay their staff too. So that's where the fee comes out, is those little spreads.
Mm-hmm. Yeah, no, I'm glad you brought that up. I mean, you take a look at, I don't know, I mean, the average commission for an advisor with these index annuities. I mean, some, again, the clients think that advisors are only selling them because of the high commission. And, I mean, there's products that's, you know, I would say an average commission rate between 4-6%. And then there's obviously trail options where an advisor selling some fixed or index annuity, and we'll get into different types. That can take a trail and make a 1 or 2%, just like a fee-based planner would.
Right. And compare that to other investments again, because everything is a tool. Again, annuity is not right for everyone, and neither is a mutual fund. They're just tools. Mm-hmm. And the key is having a contractor to know what tool you need when you're building your financial house and making sure it's built on financial good slab. And the key is when you're looking at an investment, you take the pros and cons. And one of the cons here is the fees that are tied to annuities. But there are also fees to other investments. For every gimme, there's a gotcha. Mutual funds are not feeless. Even with the no loads, a lot of times if you look at the internal expenses, add on the advisor fee of 1% minimally, it can get just as high, if not more, and you have no protection that the annuities or life insurance would provide you. So we have surrender charges, fees. What else?
I mean, we've covered, I think, the biggest ones that I hear when I'm talking to advisors, and from what their clients are saying to them, you know, maybe the contract. I mean, there are some that are out there that maybe a 12-year or 16-year contract, but again, that may be a great product for the right person.
Right. And a lot of times, what's nice is in Florida, they've actually limited it to 10 years, which is good, because I saw a lot of times where it wasn't suitable, though. Mm-hmm. You know, you see where you have an 85-year-old in a 15, 16-year annuity. Mm-hmm. It doesn't make sense, but they sold it for the wrong reasons. So, again, you just got to be careful. Now, the benefits are it provides you an income that you can never outlive. That's a huge advantage there. What are some other advantages of having annuities as part of your financial plan?
Well, just some basic ones. You've got the avoidance of probate. I think that's very important for clients to know.
And how's that, John?
Well, you know, obviously when someone passes away, this is when, you know, money, if it's in a different type of investment, it can be tied up in the courts. Sure. And people, obviously, at that time are needing that money pretty quickly. So with an insurance company, whether with life insurance or with an annuity contract, it bypasses that process and it gets paid directly to the beneficiaries.
Which is huge, because, you know, we had an attorney on, Boyles & Boyles on, and we talked about the fees that go along with probate in the process of locking up your parents' money or your money for your kids for, you know, potentially 6 months to a year as you settle out any creditor issues. With annuities and life insurance, you can a lot of times bypass that probate process. So if you're just tuning in, we're talking about the good, the bad, and the uglies of annuities. And we're breaking down to make sure that you have education so that you have clarification of these investment tools. Now, we're going to take a quick break, but when we come back, we're going to talk about the different types of annuities, because it's not just generic vanilla ice cream. They come in a bunch of different flavors, and we're going to break that down for you in just a little bit.
What your money would say. Today's financial landscape can be rough. One of the most important aspects of planning is choosing the right guide to help you navigate the road to retirement. Andrew McNair and the team at SWAN-Capital is dedicated to providing the very best service in the retirement planning industry today. SWAN-Capital is a full-service independent wealth management firm dedicated to providing guaranteed custom income plans that you cannot outlive. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. The difference between SWAN-Capital and you retire once. We help people retire every day. You should be enjoying your retirement years, not letting worry keep you up at night. SWAN-Capital. Sleep well at night. Contact Andrew McNair at SWAN-Capital 850-380-9558. That's 850-380-9558. Again, that's 850-380-9558.
The Veteran Benefit Project, founded by Andrew McNair, president of SWAN-Capital, is a nonprofit organization dedicated to helping veterans and widows of veterans with long-term care expenses by qualifying for the VA's Aid and Attendance Benefit. Learn how to receive over $24,000 per year from the VA towards long-term health care. There is absolutely no fee associated with our assistance to the veteran, the widow of a veteran, their families, or any retirement community. Our goal is to preserve the dignity of the veteran and to reduce the dependency on the Medicaid system. Again, learn how to receive over $24,000 per year from the VA. Contact the Veteran Benefit Project 850-380-5137. That's 850-380-5137. 850-380-5137. Look us up on the web, veteranbenefitproject.com. At the Veteran Benefit Project, we are committed to helping you secure the benefits you deserve.
Retirement expert Andrew McNair. Changing the retirement paradigm. Now back to what your money would say. Brought to you by SWAN-Capital.
Welcome back to What Your Money Would Say. I'm your host, Andrew McNair, and today we're talking about the good, the bad, and the ugly of annuities. And here today we have John Hogan from Financial Independence Group. His role at Financial Independence Group is to coach financial advisors on the uses of annuities. So he's a great wealth of knowledge. Now, if you're just tuning in, we talked about the pros and cons of annuities. And the pros is it can provide you an income that you can never outlive. And also can guarantee some other things that we're going to talk about very soon. And some of the cons were surrender charges, which we talked about that there are some liquidity options that many families are unaware of. And we also talked about the fees. And we talked about that every investment typically has fees, so you just have to compare the two. But now we're going to move on to the different types of annuities. And there's three major types that we're going to discuss. And the first is fixed annuities. So, John, what's a fixed annuity?
I like to kind of explain it as it's really a CD on steroids.
I like that.
I've used that a lot with advisors that I speak with. And you just take a look at the biggest benefit, I think, is really the power of the tax deferral.
And compare that with like a CD, because people understand what a CD does.
Yeah, I mean, the interest that you earn on a CD every year, whether it's, I think the national average is really less than 1%, but let's just go with 1%. You're typically paying interest on paying taxes on the interest every year at the end of the year. So it's not a compounding effect. Meaning, with the fixed annuity, the interest that you earn, you're earning interest on top of that, which is a compounding effect, which allows your money to grow a lot faster, basically. I think those are some of the two of the biggest differences, I believe.
And a lot of times you can get a better rate too.
Well, absolutely. In a CD, again, it may be right for you, but you're really going backwards if you start thinking about it.
Right. And what I call CDs around the office is GBS accounts, going broke safely. You know, we feel good about buying a CD because it's FDIC insured, it's, free from default risk. But we're not safe from inflation risk and our buying power being eliminated, because it's like being on a treadmill. You feel like you're going somewhere, but you're really going backwards, or you're not going anywhere at all. So you got to be careful with that, and we have to get at least 1%, if not more, which a lot of times we can't do in CDs. So fixed annuities provide us that option. Now, again, families feel protected in CDs, but they don't really always feel protected in a fixed annuity or any kind of annuity. Can you tell me some of the precautions and the safety features that are built into annuities? I mean, it's not FDIC insured, but there are some protection components there.
Yeah, I would encourage you to take a look at the Guarantee Association because that was built specifically really for every state, and it protects that client up to a certain limit. So every state has a limit that they protect the client up to.
Which is like FDIC insurance. FDIC is done through federal versus annuities and life insurance are done through the states, which sometimes the states are even better run. So that's the other way they're protected. The second way is I like to talk about the strength of insurance companies. Compare it to banks. If you look back in 2008 or the Great Depression, if your parents are still living, they can share with you about that. In a Great Depression or the Great Recession, you saw banks go out of business every day, and it seemed like they were changing names every day. They couldn't even keep pace with the logos. Now, insurance companies, you didn't see that. And it's because they're better money managers. Over time, they're kind of like a cruise boat. The waves will rock, but they'll go right over it smooth sailing. And it's, again, they're not loaning your money up to 10 times like the banks are. They can't do that. So contractually, they have to be very secure with your money. And if you look back at history, insurance companies have been proven to trouble those troubled times.
Absolutely. I agree 100%.
The second one I want to look at is variable annuities. That's the opposite scale. So fixed annuities are very similar to CDs. They give you a fixed rate. Now, I see a lot of families that come in with variable annuities. They think they have, a very secure annuity like a fixed annuity. Then I say, you didn't know that you own a variable annuity and that it has market risk? And they just have this blank expression. So tell me a little bit about a variable annuity.
Well, I think the biggest misconception is people think that it's protected from risk. I'll let you go in kind of more detail, but I think that people, a lot of them are sold with living benefit riders, and which is the same thing that's offered on an index annuity. And we'll talk about that here in just a little bit.
Right. So, it's a variable annuity sounds great. You have the insurance wrapper that will protect your guaranteed income for life, but you don't understand there's two values going on that you need to understand. That there's an income value that's guaranteed, but that doesn't mean you can walk away to the Bahamas with that money. What you also have to focus on is the account value in a variable annuity, which can go up and down with the market. So you got to be very careful there. The last one we want to talk about is kind of a hybrid between, and that's a fixed indexed annuity. It takes the best of both worlds and kind of combines them. Now, they're really utilized for three major things that I want to talk about today is accumulation, income, and either death or long-term care. The first one is accumulation. So, John, tell me about the two different ways you can accumulate in a fixed index annuity.
Yeah, sure. Within an index annuity, one of the main benefits is that it's linked to market gains. So a lot of the companies will use most commonly the S&P 500 to determine what kind of return that client's going to get. Some of the index annuities are capped on how much you can make, and some are uncapped.
In a cap, I'll make it pretty simple, is if the market does 30%, you don't get all that 30%. You get maybe 4 or 5% of the cap. And if the market goes down 30%, this is the great thing about annuities, is you either get 0 or 1 or 2%, just for an example. So you limit your downside and you get potentially some upside that you wouldn't get anywhere else.
Absolutely. It's something that's really designed, I think, right now the interest rates are going up. And a lot of the insurance companies have increased their rates, and you're seeing, 3 to 6% type of returns in these particular products.
So if you have any questions about annuities and you're saying, well, Andrew, I own an annuity, but I don't understand. I have a really good question I would like to ask you. Give us a call at 478-3116. That's 478-3116, and we'll be happy to answer that live on the air. Now, I want to give you a real-life example to bring to life what a fixed-indexed annuity can do potentially for a family. Let's say you have $100,000 in a CD, earning 1%, and you'd be lucky to find that these days. And let's say it's a 5-year CD. Compare that with another option where we can get a guaranteed 2% with the best case of 4%, which means you're going to get guaranteed double the rate of return initially. And what's really nice is ice cream with the cherry on top is you get 5% up front. So that means that you take your $100,000 that you had in your CD and start off with $105, earning 2%, which is double what you're earning. That exists right now. And if you want to give us a call at SWAN-Capital at 380-9558, that's 380-9558, we'll be happy to explain that specific solution for you. The second I want to talk about is income. Again, we talked about creating a family pension early on. And if you have an income gap when you retire, you can't take chances in a world of uncertainty. When it comes to your income, you can't say, well, I guess I won't take income this year in my retirement since we're in a 2008, we're in a down market. You can't do that, right, John?
Yeah, no, it's something that I'm excited about when I'm talking to my advisors is that there's now products that are out there, one in particular that where you can earn a guaranteed 7% interest rate for 10 years. Guaranteed, you pay a fee for it. It's not a death benefit, but it's something that is guaranteed to last you for life if you just choose to take an income from it. So, I mean, that's
a big number in today's market, 7%?
7%, absolutely.
Which means, and let me again show you in a real life example. Let's say you have $100,000 that you're either getting from your 401k plan and that you're about to roll over and you don't know what to do with it. And you want to retire, you want to work a couple, maybe 5 years for a part-time job, or let's say 10 for easy example. And let's say you take $100,000 of your 401k and you stick it in what John just described. It earns a guaranteed 7%, which means in 10 years you have $200,000 and you can take an income off that you can never outlive.
That's exactly right.
And again, as we discussed earlier in the show, that is huge for families today because we don't know how long we're going to live. And as medical technology continues to improve, I love to see our 72, our 75 and 82 life expectancy go up to 90. And again, I deal with a lot of families and have a lot of clients that are in their 90s. So don't feel like you may or may not live that long because you may.
Absolutely, I work on cases all the time with advisors where I've got a husband and wife. 65, 62 years old, and they're looking for income now, and the chances of one of them living to age 90 is close to 50%, that there's a good chance that they're going to live to age 90. So better take a look at something that's going to provide a lifetime income.
And that's just if you didn't listen to what John just said, I want to repeat it for you. That's basically if I have a client, a couple sitting in front of me, there's greater than a 50% chance that one of them is going to live past the age of 90. So does your financial plan take that into consideration? Financial planning is an art more than it is a science because we don't know how long you're going to live. I wish it was kind of like a race. You know where the finish line is, but you have no idea when your last breath is. So you have to plan accordingly and be conservative. The third great thing that could potentially be a good fit for you for a fixed index annuity is the death benefit option or potentially a long-term care rider that has on it. Could you explain like a long-term care rider on an annuity for me, John?
Well, it's something that can help supplement long-term care. It's not necessarily your traditional long-term care policies that you can obviously get through Andrew. But what it would do is if a client, for an example, was unable to perform 2 out of the 6 ADLs, and maybe you can kind of explain exactly what that is, or confined in the hospital for so many days. There's a lot of insurance companies nowadays that the income you're receiving, they will actually double it for a period of 5 years max. So that's definitely a huge advantage for clients that maybe they didn't prepare to go and buy traditional long-term care insurance, and they want something that they don't have to pay a monthly premium for. This is something that's built into the contract. You're already paying the fee for the income rider. It's built in, and then you're getting a income. It will double the income. So if you're getting $7,000 a year, they double it to $14,000 for a max of 5 years, which could be very helpful, I would think, to a senior looking for.
Absolutely. It's really killing 2 birds with 1 stone. You're making sure that you have an income that you can never outlive, but you're doubling it when you need it the most, which is an assisted living or nursing home. So it's a great benefit of having, a fixed index annuity that either can take care of your accumulation problems, which is if you're investing in CDs, there's other alternatives that we've talked about today. If you're looking for guaranteed income, they could be a good solution. And the last is long-term care. As John explained, sometimes you can't get long-term care because you have previous conditions. Well, this won't take those into effect. Again, a fixed index annuity or any kind of annuity is not always a good fit for everyone. And I hate to see when families have 100% of their assets in annuities because a lot of times it's not always the 100% solution. But it is a tool. And like I explained to you in the beginning, when you are choosing your contractor, when you're choosing someone to be your financial architect, you want to make sure that they know their tools and know how to use them.